Saurabh Mukherjee, Head of Equities with Ambit Capital, joins us live. Saurabh, morning. Thank you for joining us. Characterize the market environment for us. A month ago, things were looking strong, things were looking solid, but now the fear trade is back.
Yeah, I think there's plenty of concerned fund managers both in India and abroad, and the concerns are the concerns you're raising there. The plunging currency, the stress building up in the banking sector, the stalled power and infrastructure story. So the fear trade genuinely is back. It's difficult to get FIIs in particular to put big trades on India. All of that being said, I think there's my sense is there's too much pessimism in the air, and I have a nagging feeling that a lot of the pessimism is already factored into the market.
So given the kind of global backdrop we are in, sort of what exactly are you advising your clients? Are you advising your clients that this is time to exercise caution, don't chase growth, it is all about capital preservation?
I think we're doing two things at the moment. The first thing we're doing is we're saying there's no great attractions in the index per se. I don't think there's any great upside in buying the Nifty or the BSE 100. You're unlikely to get double-digit returns on a 12-month period by buying the index as a whole. Where there are significant patches of opportunity in the Indian market are in cash-generative sectors with decent balance sheets, strong underlying demand. We've discussed these sectors, I think, on your channel before. Sectors such as consumer durables, FMCG, auto ancillaries, light industrials, some aspects of Indian IT. So strong underlying demand, decent balance sheets, good cash flows, a decent management team. Many of these companies are trading at 15 times earnings or below, and that's where we are pointing our clients to and saying this is the time to accumulate these sorts of names. Grand franchises such as Exide or TTK Prestige or even a Bharti Airtel. This is the time to be buying these stocks because once India becomes the flavor of the season again, you're not going to get these sorts of names at valuations such as the ones they're trading at the moment.
Right. Saurabh, what's the sense in terms of taking contrarian calls in the market right now? Because given the volatility, that's perhaps a strategy that fund managers would adopt.
I suppose the biggest debate, and if one wanted to take a contrarian call, the biggest contrarian call to take at this juncture would be, do you go overweight Indian banks? Do you really build up a big position in Indian banks, especially the banks which are trading below book value? Names such as the Karnataka Bank or perhaps the Union Bank, J&K Bank, the smaller banks and the public sector banks which are trading below book value. Do you take that position now? Because if it works out for you, these banks will get re-rated to something like 1.3, 1.4, 1.5 times book value very quickly. If it doesn't work out for you, hey, you only lose 15, 20, 30%. But that's the big debate. Our sense is it is worth having a few Indian banks in your portfolio, but if you want to have banks in your portfolio, go for banks which are overcapitalized. Names such as Kotak, such as Federal Bank, amongst the larger names would be the ones I would look at. Bob perhaps in the PSU space. Bob and Federal are at 1 times book value. Kotak is at 2 times book value. That's the sort of name I would go. High quality banks rather than the really depressed valuation multiples. So that is the really big debate at the moment. Should one build up an overweight position in Indian banks? I'm not convinced that I've got the appetite for that sort of risk, but I certainly would recommend having a couple of high quality banks in your portfolio.
So what is driving consumer names? Lack of options? And do you think at these levels, consumer stocks are pricing in a near perfect scenario that nothing will go wrong with them?
Clearly, a big part of the rally into the Nestle's and Unilevers of the world is lack of options. But that being said, one has to give credit to these companies as well. Unilever's numbers were outstanding. Dabur did well. ITC continues to go from strength to strength. So it is partly the fact that there is very little else which jumps out at you and asks you to buy it, and also the fact that the consumer names are delivering numbers. The question that a lot of clients are asking us, a lot of investors are asking us is, can the Indian consumer really stand tall in all this pressure? Or are we 2 to 3 quarters away from a big collapse in consumer confidence and consumer spending? I don't have the answer to that at the moment. We're doing a lot of work on that question. At this juncture, based on everything I see, the Indian consumer is still standing tall. He's still spending money. He's reducing his savings to spend money. How long will he continue doing that is a big question that I think people like me need to answer over the next 2 to 3 quarters.
Is there merit in revisiting oil marketing stocks given the way how crude has cracked in last 10 days?
I think you can try to play crude on a short-term basis using OMCs. The challenge I find with the entire oil and gas sector now is the government interference is so overbearing. And sort of difficult for us to second guess what the government will do has become so meaningful that by and large we are quite heavily underweight the entire oil and gas pack. So whether it's an ONGC, an Oil India, or the OMCs, or indeed something like an IGL, the problems around second guessing the government are actually quite meaningful. So I would say as a retail investor out there, it would be relatively hazardous to try playing the oil and gas sector in any meaningful shape or form at this juncture.
And the aspect that the management highlighted in terms of augmenting sales is increasing recoveries. Now that's something that comes in very critically in this sort of a market environment or business environment where you obviously try and generate higher cash flows. In lieu of that, how would you view the business of gen irrigation?
I think it's interesting you had SKS and Jain in quick succession, and I can't but help comment on those two franchises. I think Jain is fundamentally a superb franchise. The sprinkler systems, the irrigation systems franchise is really a classy franchise. Our only concern with the company, and it's a meaningful concern that's cropped up over the last year and a half, is this NBFC side of things, the lending side of things. It's a very different skill set. The superb irrigation franchise is world class, but here providing financing to farmers is a very different skill set, and we are still unsure as to how strong they will be on that front. But overall, a superb franchise with some concerns on the NBFC side. I think SKS, I would say, is the flip side of that. Fundamentally, the business model doesn't stack up in my head. It's not as if it's Andhra Pradesh is the only problem. Even outside Andhra Pradesh, I find it quite difficult to envisage how that business model will make money. And I don't think it's all because of regulations in Andhra Pradesh that they stumbled. So SKS is a fundamentally difficult business model to stack up. These sorts of models have struggled in other parts of the world. For-profit MFIs, I think, remains a dicey proposition in our country, and tinkering around with that or playing in that stock, I don't think will be a particularly sound way of trying to make money in today's India. So two very different franchises. One, a fundamentally solid franchise, Jain, and the second one, a fundamentally unsound franchise which is hard to stack up.
Brilliant illustration, Saurabh, for Jain Irrigation and for SKS Microfinance. My compliments on the way you explain both these franchises. Okay, final question.
Thank you.
Give us one large cap name, one mid cap name, one small cap name where you're confident that if somebody puts in 100, they will get 130 back after 1 year.
You make life very easy for your panels, whether it be the corporates or for the stockbrokers. In the large cap space, I would look at HCL Tech quite closely, with the dollar sliding and HCL Tech having a clear strategy and business momentum behind it, with the US economy gradually recovering. I think this is the best of the frontline IT players in our country at the moment. So large caps, I would point you to HCL Tech. In the mid cap space, I would point you towards Exide. It's had a rough set of results. As a result, the company is trading at around 130 odd levels. It's a champion franchise. Very few. There is very little competition to Exide in the overall battery market. And at 15 times earnings, I think Exide makes a great deal of sense to buy. In the small cap space, I would continue looking at the tobacco names. So VST in the small cap space is at 12 times earnings, 6-7% dividend yield, relentlessly cash generative. And in the entry-level cigarette segment, VST, I think, has something like 60-70% market share. So cigarettes at the smaller end, VST, batteries at the mid-cap end, and IT at the top end, HCL Tech.